Welcome to Make a Difference with RJ channel. Reading 3, Overview of Asset Allocation. So overview of asset allocation is first part of 3-part series. This is kind of a big picture before we do asset allocation. So what are we going to cover in this video? Investment governance. In this part, most important topics are how to define investment objectives. What is investment policy statements? IPS, and there are a few other things. Second is economic balance sheet. So you are already familiar with accounting balance sheet. Why do we need economic balance sheet is covered, and then benefit and example. We will see approaches to asset allocation. Again, this is a big picture perspective of different ways of to do asset allocation. And we will see example of strategic asset allocation, other approaches and issues will be covered. Investment objective. This is the most important part before you start doing long-term asset allocation, and that is to define objective. And this is very simple and intuitive to understand, but you will need to memorize certain keywords in this one. For example, a pension fund. So what is the objective of the pension fund? The objective of a pension fund is to ensure that its assets are sufficient to cover both the current and future liabilities. Then we have endowment fund. The endowment fund's objective is to achieve a return that exceeds the amount necessary to sustain both present and future distribution. What would be the individual's investment objective? It would be the objective to accumulate enough for retirement, or maybe to achieve the goal, certain goal, considering their constraint and risk preference. So investment policy statement is a document that outlines how your investment will be managed. It explains your financial goals, how much risk you are willing to take, and the guidelines for making investment decision. It acts as a roadmap for managing your money, helping ensure that your investment stays aligned with your objectives. And let's see example of IPS. Now this is a sample IPS for 40 years old. See, we have goal of that person, time horizon, risk tolerance, asset allocation. Now this asset allocation will be fed into IPS after you do the strategic asset allocation. Once it is done, then it is included into the IPS. Then of course investment strategy would be there, review, when are you going to review, when are you going to do the rebalancing, and then also if there is any tactical asset allocation. So the whole thing is, it will keep changing as this person gets older, and if there are many other constraint and other things there in it. Now I'm just going to cover 4 other points before moving on to other things in the investment governance. The rights and responsibilities. Now, based on the size and staff of fund, an investment decision should be made by most qualified person. Mm, and strategic asset allocation. So who is going to approve this asset allocation? Highest committee, and it should be done after the IPS and simulation and after considering the risk and return attribution of all assets. Then there is a reporting framework. This framework should state current status of investment and whether the program has added a value or not. And then governance audit. So this is where independent third party audit is necessary, and also new staff should be trained properly. So economic balance sheet is like accounting balance sheet. It contains liability, asset, equity, but it also contains extended income and expenditure. Extended income is present value of expected earnings like future salaries, pension fund, royalty, and any future income. And extended expenditure is present value of expected liabilities like payment of loans, mortgages, payouts, any future expenditures. So here is the economic balance sheet sample, and also what is the benefit of it? You can incorporate future income and future expenditure in investors portfolio. That would give us a good strategic asset allocation. It will give us a good risk and reward ratio. So this is a sample of economic balance sheet. It says the financial assets include cash, investment, and other investments. So we have cash in saving accounts, investments in stocks and bonds, and other investments in home jewelry. And this is part of accounting balance sheet. But here we have added human capital. So this is expected earnings, say for example, before till the time a person is retired. And there are liabilities. Now the liabilities are again exactly like accounting balance sheet, which has car and home loan, but also we have expected expenses added to this economic balance sheet. In the approaches to asset allocation, there are three questions we are going to ask. First is, how is it done? What are the approaches to asset allocation? Second is, who would use it? And the third is, how do we measure risk? So we have three approaches. How is it done? Asset only, liability relative, and third is goal based. Who would use it? Now the in asset allocation, decision is made based on only assets. So who is going to use it? Those people who has assets, only assets. They are not worried about the liabilities. So maybe an individual person who doesn't have a liability, just asset, or any fund which has a long term goal and they are not worried about the liabilities. The second is liability relative asset allocation. In this one, decision is made based on assets and liabilities together. So who is going to use it? Of course, the any person, individual who has assets and the liabilities, or a fund, pension fund, banks who has assets and a liabilities. And third approach is a goal based approach. Here the decision is based purely on the goals. Now there are different ways to do it. Now asset allocation with the assets only is done using mainly mean variance optimization. This part will be covered in more detail in the second part of the asset allocation. And in the liability relative approach, we have surplus optimization, return seeking, and asset liability approach together. Then goal based approach, it is like a creating sub portfolio for each goal. Now, in all three types of approaches, how do we measure a risk? In the first part, asset allocation, we measure risk by standard deviation, or using a VAR, value at risk, or using a maximum drawdown, or the semi-variance approach. And the second one, liability relative asset allocation, primary risk contribution volatility, like a standard deviation of surplus. We will do that. And in the third one, how do we measure risk? Not being able to achieve goal. So weighted sum of risk for each portfolio. In the asset allocation series, second part will cover in detail about how we actually do the asset allocation. But before we go there, how do we do the asset allocation by assets or risk? And what are the asset classes? How to define those asset classes? Then asset allocation by assets and problems with that. Then we have asset allocation by risk factor and problems with that. Let's learn. So let's define asset classes. There are three super asset classes. One is a capital assets. Capital assets include stocks, bonds, real estate. They provide cash flow. Like stocks provide dividend, bonds provide interest rate, real estate provide rent, and also all three provide capital appreciation. The second superclass is consumable or transformable assets like oil, agricultural products, metal, and value is derived from supply and demand and usefulness in consumption or production. And the third asset class is store of value assets like precious metals, collectible arts, currencies. Value is derived from hedging against inflation. So it is not a real value, it's like a perceived value. Why do we need to define asset classes? So imagine manager is there and he puts distressed bonds and government bonds in fixed income. Say for example, a manager puts a micro cap and a large cap under equity. So in this case, if manager puts these things together, then there is a no proper diversification benefit. Portfolio rebalancing would be very difficult, and this is not a correct way of strategic asset allocation. So that's why we need to define asset classes. Okay, how to define asset classes? Assets within a class should exhibit similar characteristics, behavior, and risk return profiles. This consistency helps in predicting performance and applying targeted strategies. This is called homogeneity. Then there is a mutual exclusivity. Each asset should fit into only one asset class, avoiding overlap. This ensures clarity in asset classification and reduces redundancy in allocation. The third is diversification potential. Asset classes should offer meaningful diversification benefits by having low or negative correlations with each other, reducing overall portfolio risk. Then liquidity, asset classes should include investments with a similar liquidity characteristic so that the investor can meet liquidity needs without significantly impacting the portfolio's composition or value. And the last is accessibility and practicality. The asset classes should be easily investable and widely available, allowing for practical allocation. This ensures that investors can implement their allocation without unnecessary barriers. Now, these definition of asset classes are intuitive and there is no need to memorize them. You just read it few times and try to understand them. So there are two ways to do the asset allocation, either by assets or by the risk factor. In asset-based allocation, we do allocation by our specified assets. Problem is risk factors are overlapped. For example, inflation affects equity as well as bonds. So same with other risk factors such as interest rates, foreign deficit, volatility, domestic currency, etc. Asset allocation by risk factors is identifying risk factors and do allocation by risk factors to overcome overlapping risk problem. A risk factor allocation may not be for all types of investors, as not everyone would like to invest in derivatives, long short equity, go long treasuries and short inflation linked bonds, and may not be practical to invest considering transaction costs and risk aversion factor of investors. So let's take one question on the strategic asset allocation. We have Seema who proposes goal-based allocation for achieving a couple's goal. She designs and presents three asset allocations and three asset allocations are as following A, B, C and each one has a different allocation to different assets. Now question is identify and justify with one reason asset allocation for following goals. One is home renovation after 2 years. So which asset should she choose for the couple and why? And retirement requirements after 35 years. Now the first one is as we can see it is short horizon. So that's why we have to choose A. How do you write this kind of a essay question? Do not need to write the full sentence for it. You just say 1A. So asset allocation 1A because short horizon. So the reason is this home renovation is just after 2 years, and asset allocation we have given only three types of asset allocation, and only one asset allocation type has a lot of cash, 45% of cash allocated to the cash actually. So that's why we are going to choose A. Now, the second one is a retirement requirement, and that is after 35 years. So it is a long-term horizon. Which one will we choose? We will choose the growth kind of a asset allocation. So it will be C because we have lot of allocation to the alternative investment, which allows us to grow this investment for the long time horizon. And how are you going to write? Just write C, long horizon. Once strategic asset allocation for the investor is decided by the manager, the next question is how to implement this choice. There are two ways to implement it. One is implementation by weight and another is implementation by management. In the implementation by weight, we have again two choices, TAA and DAA. TAA is tactical asset allocation, kind of active choices in which a manager may take advantage of short-term cycle. So if there is a crash in the market and there are some sectors which are bottoming out, so to take advantage of that, manager may increase weight in those sectors. And the DAA is kind of a dynamic asset allocation is a passive choice in which the decision is not subjective, but it is objective, where whenever the weight is increased by the corridor, by the range, then it is automatically brought back by rebalancing. Now in the passive or active management choices, we have passive management and active management. In passive management, manager may decide to just invest in indices, and in active management, management may decide in investing in active management by creating a portfolio of stocks. So all these decision of strategic implementation choices is recorded into our investment policy document, IPS.
Last point in this reading is rebalancing. As we saw that we can have dynamic asset allocation, which means bringing back asset allocation to targeted weight. And how to do that? There are two approaches. One is a calendar rebalancing. This is a very simple approach. Let us say every quarter look at the asset weights and buy or sell to change weights. Second approach is percentage range rebalancing. So if our asset allocation is 60 and 40%, there is a corridor of plus minus 5% range, which means if equity goes from 60 to either 55 or 65, do nothing. But if it goes below 55, then buy, or if it goes above 65, then sell. So what is optimal corridor then? What is the range? And this is a very important strategic consideration that depends very much on the following things. And remember these points. Now, transaction cost. So higher cost of the transaction, then the range should be wider. And risk tolerance, if a person has a more risk averse, then it should have the smaller range. And the correlation is a very important. You would say, why high correlation require wider range? Because it's a little bit strange, but look at this. See, if the equity moves up 15% and bond also moves up 10%, both move together, then asset weights don't change very much. The equity weights has changed from 60 to 61% and the bond weight has changed from 40 to 39%. But if both are negatively related, say equity moves up 15% and bond moves down 10%, then the weight change drastically. See, equity has moved from 60 to 66% and bond has moved from 40 to 34%. So that is why if the correlation is high, then you can keep the range wider. Okay. Now, momentum, if someone believes in a momentum, then the range can be wider. And liquidity, if the liquid asset is there, then we can keep the wider corridor. The use of derivative also requires wider corridor. And tax cost requires wider corridor. And volatility, higher volatility, wider corridor. So remember all these points. These are very important points.
So I have created a mind map, and you can download mind map PDF from the link given in the description. See you in the next video. Don't forget to comment, like and subscribe.